it's really about finding the people that match with the business plan. So not everyone wants a long-term investment. It's not like doing a refinance after a couple of years. That helps with a lot of people, but there are people that really just want to like get their money in, get it out quick, like 3 to 5 year hold max.
Yeah.
That's like get peak IRR, right? Like a lot of the recent investments have focused on what is the IRR, giving the highest IRR.
Sure.
That's really much more about speed of money than it is about overall return.
Yeah.
So we focus a lot more on unlevered yield on cost, which takes out it strips away leverage. So it strips away like whatever the lending's doing. I don't care what interest rate is necessarily.
You're listening to the Accredited Investors Only podcast presented by Accredited Life.
Rachel, welcome to the show. How you feeling today?
Doing good, Peter. Glad to be here.
Hey, I'm glad you're here. Well, let's start with an introduction. So, Rachel, who are you? What do you do? Why are you here? All that kind of stuff.
Sure. Currently, I buy apartment buildings in Charlotte, North Carolina, about 2-hour radius around there. So everything up to Triad, down to Greenville, South Carolina, down to Columbia. But my background is actually, I come from engineering. So I've got a master's in mechanical engineering. I used to do gas turbine design. And then I got into real estate about 10 years ago as a side gig, side hustle, and kind of slowly built from there. A couple years into building that side gig, I had an epiphany that we could actually buy commercial properties. So we started looking into that, realized we were going to need some more capital, and then started diving into syndication. So I've been doing multifamily syndications for a couple of years now.
Wow, awesome. That sounds like a very interesting story that I'm sure a lot of our listeners can find something to relate to there, because a lot of times accredited investors, engineers, one of those things you hear a lot. What brought you there? I mean, was that something that you always wanted to do, or I'm assuming obviously you went to school for it, and also what was that like?
That's an interesting background, actually, because I did not want to be an engineer growing up. I went to Durham School of the Arts for trumpet and ceramics, and then I went to
What a different
college. I know. And then I went to college thinking I'm going to be a veterinarian because I rode horses and I worked at the barn. That was my high school job.
Okay.
So I was like, okay, I'll go be a veterinarian. So, and then about, I don't know, a year into that, it got boring. They were giving me a lot of classes that I'd already taken. And I saw some people playing in the hallway of the dorms with these little, I don't know, MacGyver boxes where they were putting like bolts and nuts and popsicle sticks together to make little pullback cars. I was like, oh, looks like a fun class. How do I take that one? And they're like, oh, that's intro to engineering. You've got to switch majors. I was like, okay. So I switched majors into engineering.
Wow.
And yeah, I just kind of went through.
You're messing around.
Way. Yeah, it just looked like fun. And I mean, there was certainly some tough classes. I did have to take statics twice, but I made it through, and I love doing. I did an off-road Baja project, and yeah, I ended up getting hired by GE Energy in Greenville, South Carolina, out of college. So I lived there, got my master's through them. They paid for the whole thing, which was great, while I was also working full time. And yeah, met my husband while I was at Tech too. I went to Virginia Tech.
Wow. Okay. That's awesome. I mean, so the engineering, the foundation in engineering, it sounds like, is a huge part of your life. What led you to, want to do the side hustle and real estate and things like that? What was kind of the catalyst and the introduction to that?
Well, the typical catalyst, which is we were about to have our first kid, and both my husband and I are in the energy industry. And at the time, around 2016, the industry was taking a dive. There were a bunch of people getting fired around us. And we're like, we're about to have a kid. If we get fired, what are we going to do? My father-in-law does single family rentals up in Roanoke, Virginia, and he'd been harking on us to get into real estate about 2 years before then, which I really wish we'd listened to him looking back now. But at the time we're like, oh, we're fine. We've got plenty of, like, the two of us are working.
Sure.
Dual income, no kids. And yeah, that finally struck us. So we bought our first purchase, which we bought all cash, was 2 single families in South Gastonia. They were $20,000 each, so $40,000 total. Wow. 600 square feet, built in the early 1900s. One had a drug dealer, the other one had a heroin addict, and that was our introduction into real estate. We did all the work ourselves, fixing the floors, learning from my father-in-law. Like, we're engineers, right? My husband has his PE, so we did the wiring and learned how to tile floors, learned how to do plumbing. And then, yeah, we figured if they burned down, we were still going to make money. Was kind of how we looked at it. And those ended up working out. It was a tough time. I had the baby with me. I
I could
remember very
imagine.
fondly going to urgent care. I cut my hand doing flooring one time with an X-Acto, and I had the baby carrier and my hand bleeding in the other, trying to drive to urgent care. And
Yeah.
yeah, maybe not the smartest move, but looking back, I'm glad we did it because it certainly got us interested and taught us that, even in these little houses that, I mean, the roof's sagging, there's like none of the walls are plumb. You still ended up being a really good investment. We sold those 2 years ago now to help fund some other investments.
Gotcha. Wow, that's amazing. I'm sure there's a lot we could talk about with what you learned there, and it might come up, as we kind of go through your story and all, because it sounds like there was a catalyst to the commercial side of the business too. Like, how did that happen? Like, why did you want to get, as people always say, level up into multifamily and that kind of thing? I'm curious to what was the catalyst for that? How'd you get to there?
Yeah, so I said after a couple of years, we realized we could buy commercial. We bought a 6 unit, about 20 minutes from us. And it really opened our eyes to, hey, if you have everything on one place, one building, then the economies of scale really start kicking in. So we started thinking, okay, well, maybe we want to trade up into some other properties, and quickly realize there's a whole other level to this where we can actually partner with people and buy even larger properties that are newer, nicer, but mainly get better returns. And
Mhm.
as you probably got a sense already, I'm a big project person. I love a good project. And so doing the heavy value add doesn't really scare us. We've done a lot of stuff ourselves already. And so we really kind of dove into how are we going to do this. My first syndication, I partnered with Brady Hoffpower, who I worked with at Siemens, and we had worked together a lot before. So we knew how each other would operate and that we would partner well together. And yeah, it's done really well. Been very proud of how that one turned out, and it's kind of helped us get to the next, kind of keep growing the business.
Gotcha. That's awesome. So it sounds like there's been a lot of like there's been a what's the word I'm looking for? It's just you've done things and then it's led to the
Yeah,
bigger,
baby
better,
steps. Yeah.
exactly. I think that's a great way to do it. It teaches you. It builds a foundation, right, that you can work off of as you move up.
Mhm.
It sounds like too that you've stayed very local. Did you grow up in the North Carolina, South Carolina area, or what did that look like? What's brought you there? Like,
Yeah, I grew up in Durham, North
okay.
Carolina. So I love it here. It feels like home to me. So I lived in Durham, went to Virginia Tech, lived in Greenville, South Carolina. Now we live in Charlotte. I really love this area. I know the people, I know how it works. And I mean, to be honest, like we didn't move here thinking of real estate. We were moving here for
Mhm.
our normal jobs. We just happened to get really lucky that it's also a great, great real estate market.
Yeah, without that, that's what I was curious, because you talk to so many different people that yeah, either have to invest out of state because of where they're at, or they've chosen to, for some reason or whatever, to move to a certain place because they liked, the dynamic of it and that kind of thing. But you were kind of in that area to begin with. Is How much of a difference has that made? Like you said, you seem like you know those markets very, very well, and that's got to be a huge competitive advantage, especially when you're in a market that probably gets a lot of outside attention from other, I'm sure there's people like I live in Pennsylvania. I know people in Pennsylvania that will go into those markets and try to find deals and that kind of thing. So, what's that competitive advantage look like when you grew up there? You know the market, all that kind of stuff.
It helps a lot to be able to go, like, the neighborhoods, right? You can drive into something or you can look at something on a map and know exactly what kind of demographics you're dealing with. So you can know, all right, you can't reposition like this particular property, you could reposition to a class A asset because you've got these new developments going on. You're seeing them all the time. Like there's stuff that you can't find on Google Maps
Sure.
where there's new developments going on. And but then there's other neighborhoods that are older where you go in and some people are like, oh, you can raise rents to, I don't know, 14, 1500 for a two
Yeah.
bedroom. And you look at it and you're like, that's not the right business plan for this, just because that demographic's not going to move here for
Mhm.
one reason or another. So
Yeah.
you can really tailor how the operations need to go so that the business plan works best. So you can get really the best returns on that particular property when you're going after something.
Yeah, that's all. I think that makes a lot of sense, and it's something. I think for investors to always look for, is what is that local connection? How well do you know the market? All that kind of stuff. And growing up there, you can't beat that. You know what I mean? It's definitely gives you that competitive advantage. So talk to me about the buy box. What are you looking for today? I'm assuming you're working with brokers, and then do you also, look for off market deals and that kind of thing? Like, so when you, what's the acquisitions process look like for you?
So I do work a lot with brokers. It's really a lot easier to find more people. It's almost like having your own team
Yeah.
where they know your buy box, you're very clear about it, and they know what you're looking for, so they can kind of funnel stuff to you. Now that said, we also look off market and make phone calls. A lot of it's driving for dollars to see
Mm.
we know the neighborhoods that we want to be in and
Yeah.
being very specific about I want to be in this 2 block radius around these particular things. For me, I'm looking for walkable, bikeable areas. I'm a long-term investor, so I'm 10 plus year holds or pretty much everything we underwrite.
Nice.
And that is helpful because what we really do is we try to front load the CapEx so that the systems get updated. So a lot of these 1970s, 1980s products really need like the cast iron plumbing, like
Mm.
pipe cast system or like they're 50 years is how long they're supposed to last. So
Mhm.
they're definitely end of life. And that's a big expense. And sometimes they're totally fine. You just got to do that during due diligence, but you still need to account for the fact that that's a big expense that's coming up sometime while
Sure.
you're holding it, right? Like you're no longer assuming someone else is going to take care of that
Yeah.
when you after you sell it. Like it's your responsibility. You got to figure out how to manage it.
Yeah.
And that changes how you invest in the property. Is you're investing more for robustness, trying to make sure that things last for a long time. They can hold up to a variety of tenant types, to small children, to people anybody throwing furniture around. Like it's really interesting when you start thinking of it from a different perspective. Like not how cheap can I get this done, but how well can I set this up so that I never have to pay maintenance. Like if you say, how do I make this so I never have to pay another maintenance dollar into this? It just kind of works. That's a very different mindset going into CapEx updates.
You're speaking my language there. We buy a lot of single family, and we buy those fully blighted, dilapidated homes that we can go in and just essentially rebuild within the four walls, because it's so much less work from a maintenance perspective. When you got a value add, and you're kind of just the proverbial throwing lipstick on a pig kind of thing, it's going to eventually come back to bite you. Once you move a tenant in and they're actually living there for a few weeks, a few months, they go through the seasons and they go through, the heat or the AC or whatever it is. And then you end up finding out the problems and stuff like that you would never know, in a due
Sure.
diligence or, because whatever you went there during the summer, so the heat wasn't on or vice versa. So, how did you get to that confidence level in the heavy CapEx and these heavier value add type deals? I feel like a lot of people are, they're scared of deals like that in some way, shape, or form. What was it your background and all that kind of stuff and doing those early properties where you were in there doing all that kind of stuff? Because I'm assuming now you're working with general contractors and doing that. You're not in a I don't know what we'll have to talk about what size properties you're buying, but if you're buying a 20, 30, 100 unit apartment, you and your husband aren't in there, hammering like you used to be, or adding
Anymore.
cabinets and drywall and stuff like that, right?
Right. I was a big day when I could actually hire people to do
I
the work
bet.
for me instead of having to run out there to do it myself. But I think that like doing it yourself counts for a ton. Like you learn
Sure.
all these little details about like what a shark bite fitting is, or like what kind of drywall mud actually works and is easy to
Mhm.
work with. But at the same time, I think a lot of my expertise in it comes from my engineering
Mm.
experience because I did like the gas turbines themselves are spinning at 3,600 RPMs. They're running at 2,000 degrees Fahrenheit. They're supposed to run for 10 or 15 years. So I was a lot of risk management of having to go into the design of those and applying that mindset to an apartment building, which isn't under the same stresses and strains. There's a lot more people, I think, on a day-to-day basis interacting with it, but it's still a very similar project management kind of feels like, okay, if this thing has to last for the next 10 plus years, how do I make that as robust as possible? And it all comes down to the little tiny details. Like the big systems, like you can make it look pretty with paint. Paint's amazing, by the way. It's definitely the best ROI you can have. But if you ignore like the little stain on the ceiling while you're painting, that's going to come back to bite you, because then there's going to be a tenant in place, and then you're going to have like a plumber come out and then a drywall person come out. The handyman can do some of it, but if you're at a higher end tenant, they're not going to be able to, like, you can't leave the hole open because the drywall person can't come for 2 days. So you've got to figure out how, like, the best thing you can do is fix it as soon as you see any kind of sign of it. And the only way to do that is preventative maintenance and upfront CapEx investment.
Yeah. Wow. That's something I feel like a lot of people kind of have to learn over over time, right? It's just like you
have to go through the phases,
right? I mean, sometimes you got to feel the pain, and I'm completely on your side of the spectrum there. I'm somebody where if I get a call from a tenant for some kind of issue, I want that thing fixed. I don't want to throw a Band-Aid on it. You know what I mean? I want to fix, because, and I've learned that myself too, doing things over the years where I said, I'm going to go and fix it, and like, to your point, I think there's something to be said for knowing how to do everything, and having a personal feel for it. This way, ideally, you're not going to be taken advantage of when you're dealing with GCs and stuff like that. They tell you got to do this, that, and the other, and you just understand the process better, so you know what to kind of expect, and that kind of thing. But I've wasted a lot of time and money where I go out and I think I'm going to fix something, and then the next day I get a call and it's leaking again, or that kind of thing. And I realized it's better to just pay the first time around, get it done right, because it ends up being cheaper. The Band-Aid, when you got to send people back and stuff like that, it just doesn't. Or you're, like you said, you're getting a handyman one day and then you're getting the roofer out or the plumber out the next day or something, and it's just, you end up wasting money that way. How does the market, like, does that market have a lot of this older vintage where somebody's has owned the property for a very long time, and it needs a lot, there's undervalued rents and things like that? Like, that's, paint a picture for what the market looks like from that perspective, because that's what I'm assuming, but I could be wrong. It's been very popular there, so I don't know how many properties changing hands frequently, that kind of thing. Or
yeah, Charlotte proper has been picked over quite a lot for a while, and it continues to be a very, very competitive market, even for the older stuff. There's a lot of 1970s, 1980s kind of product here, and there's a lot of brand, like, new 2000s level stuff. There's like this middle area where there weren't that many units built during, but at the same time, that's why there's a lot of demand even for the older style units, because they're often in better locations too. Like, so the brand new stuff, if you can go all the way into Class A, I mean, in Charlotte, that's running you at a 5 cap roughly right now. Like, you're getting, it's pretty, you can get some really nice stuff. I think I saw a really nice one for like a 5.5 cap at Huntersville last week. But that's not normally where I play. Like, I would love to get one of those if they're financially distressed, but because I'm looking for those higher returns, I've still got a long way to go. That's more for if you just want to kind of park your money, get a really good asset, kind of go along with the appreciation. Because I'm very long Charlotte. But the older stuff's kind of more where I play. And those, I typically look actually around Charlotte and kind of the secondary markets. There's a lot of little tiny towns around Charlotte that have these really cute little downtowns. A lot of times they're higher income than you'd expect, like $80,000, $100,000 average median income in this little tiny neighborhood around this downtown. And those are really great areas because they're typically mill towns. So they've got like old brick, like 2-3 stories downtown. And the older kind of multifamily products are mostly townhomes. There's a lot of townhomes around here, which is really, really popular. But yeah, I've really enjoyed, like, that's kind of where I focus on a lot. Like, I go into those smaller towns, but it's also why I kind of expanded my radius. So Charlotte's kind of my home base, but I love Columbia, South Carolina, which not a lot of people talk about, but there's a ton of cool stuff going down there. Bull Street District is like a $1 billion like new medical campus with all this new stuff going on. There's a new manufacturing plant down there for automotives. There's just a whole lot of stuff that are going on in the regions around Charlotte that I think are just as interesting as Charlotte itself in terms of value add returns.
That's awesome. So what is the typical like size for properties that you're looking for? Is there a certain range that you want to be in, or what's that look like?
I try to stay below the institutional level. I just don't want to play with the big guys. I want to be the big fish.
I would think there's a lot in those markets too, right?
There are. Yeah, and you can kind of, it's nice because you can kind of see where they play. So like Greensboro, institutions like as well, but Winston-Salem, which is right next to it, they don't look at as like they don't typically go into that market. And so even though it's got kind of the same feel to it, so I look a lot in Winston-Salem as well. But yeah, in terms of unit count is it kind of depends. It's more on the value side. So I want to look somewhere in the $2 million up to maybe about 20 million, 20, 30 million range.
Okay.
In order for a purchase price, which is a pretty wide range. But then when you think about it, like downtown Charlotte, if I bought a quadplex down in downtown Charlotte, it'd probably be about $2-3 million.
Yeah, exactly. Yeah.
Whereas in like Columbia, South Carolina, I could buy a 30 unit for $2-3 million. So there's the unit count is less important in terms, it's more about the total amount that we're investing in the property so that we can get the returns, because like you want to be able to bring investors along and they want to make enough return on their money to make it worth it.
Sure. So talk to me about the CapEx side of things and how you're underwriting for the long haul there, because I think that's an important aspect, but it could also, I'm curious to like how conservative the underwriting is, because it's hard to know what's going to happen in 10 years out, that kind of thing. But at the same time, you could feel, somewhat confident that it gives you a lot of time to be able to recover and from a downturn and things like that as well. So I'm curious to, how you underwrite, and just kind of how you balance the doing things right up front, and that heavy CapEx and renovation and rebuilds and that kind of stuff versus, how you look at the market long term and how you look at the rent appreciation and cap rates and things like that.
Yeah, so you probably gathered I'm more on the conservative side of the spectrum when I'm doing underwriting. And a lot of that has to do with there's a lot of unknowns in real estate, especially on the operations side. And if you talk to a good property manager and have them help you look at your operations, they'll tell you how much things actually cost. And if you're not taking your property manager's input in order to figure that out during your underwriting, or you're ignoring it and saying, "Oh no, we could definitely run it better because I'm just better than what they're saying."
Sure.
You gotta believe it. Like they're the experts. They're doing their jobs for a reason. Now they're better property managers than others, so
Sure.
getting a variety of opinions helps. But I wouldn't ignore line items completely just because, like, unless you have a very good specific business case of like, I'm lowering the water bill because I'm doing a water conservation investment program where I'm replacing all the toilets, replacing all the faucets. Like if you have a reason, that's totally fine. But you've got to your point, you kind of got to balance that. Okay, upfront CapEx. A good example would be like in North Carolina, you can't do a RUB system without getting approval from the Utility Commission. And you typically need to have a water meter for every unit in order to do that. And so a lot of these older properties are on single meters.
Yeah.
And so like you have to pay a company to install water meters either after the hot water or after the main on every single unit. So that's an investment up front. But a lot of times you can recapture that within a year, as long as you can because you're now actually capturing water billing and the rents. When tenants are looking to rent properties around here, they don't properly account for how much the water costs. So if you say utilities included, they might say, "Oh, that's worth like 10 or 15 bucks." It's actually worth more like 50 or 60. So you're not getting that value out of you're not getting, there's extra value to be captured there. But you have to make that investment up front in order to know that. And then again, if you're holding it for the long haul, that makes way more sense even then, because all right, you're recapturing after a year and you just get that extra for the next 9 years instead of the next 2.
Yeah. So how do you structure the raises, for the capital raises, when you have heavy CapEx up front and all? I'm assuming you have to raise some capital for operation costs and things like that, and then how do you do it? Kind of moving forward, balancing cash flow and all that kind of stuff when it comes to your CapEx plan over the course of a few years, that kind of thing.
Yeah, so if the day one CapEx gets raised the same way as we would for the property purchase price, because it's all okay. We're going to go in the next 12 to 18 months. Typically, we're going to do new roofs if we need it, or we're going to have to replace the HVACs, or we're going to do major upgrades to all the units to a platinum level with graded or new stainless. Like that's kind of the day one. So the initial phase of the business plan all gets raised up front. Everything gets treated the same. After that point, the CapEx that maybe didn't need it. So maybe as an example, like a roof, right? So roofs can last up to 30, 35 years if you're pushing it.
How many
But a lot
times
of
can you
times you'll
patch
get
a roof? Especially all these commercial properties. It's amazing, what you see people do with patch jobs. Oh my God, yeah. Woo.
yeah, yeah, there's a lot of
It's never
time.
like HVAC systems at all. It's just like how many times can you get a guy out to get that thing working again? It's amazing.
So yeah, with HVACs, we have a number of properties. We have original HVACs. So they're like 40 years old HVACs that are still running, and people cannot believe they're
Yeah.
still running.
Yeah.
But they're built like tanks. Like they don't have any parts to really fail. So you just like connect the wires back together and it keeps
Mhm.
going. But anyway, back to the roof, we had a 10-year, if you have a 10-year roof, for example, you're not replacing that day one. So I'm not raising the amount of capital I need to replace that day one. What I'm doing instead is building up a CapEx reserve over
Yeah.
time.
Yeah.
So
What
a lot
percentage
of
does that
people,
look like for these properties?
it depends. You can actually make a schedule of that. So
Yeah.
I typically end up using the typical lifespan. So like a roof is maybe 30 years. HVACs are more like 8 to 15, depending on which one you get.
Mhm.
You can do it up to flooring. It's almost like creating a depreciation schedule that you
Yeah, I was gonna. It
a cost
sounded like when you
a
said
cost
that. Yeah.
segregation. Yeah.
Yeah.
You can almost use that same kind of lifespan to build out when you're like how much reserves you need for your CapEx plan. So it's like, okay, just instead of everything starting out brand new, you're starting at this point.
Yeah.
We think it's gonna have to be paid for here. So now we can figure out what the reserves on this property need to be on a
Yeah.
monthly basis so that by that point we've got enough capital to just afford it. And it's not a bit like we're not gonna have to pull from somewhere.
Yeah. I love that because I've had that with investors where they kind of just look at your overall expense ratio and they're like, it should be, at least 40% or, at least 30% or, somewhere in that world. You just think, well, you got to take into consideration that these are newly renovated properties. It's almost new construction. You know what I mean? Like and the investment life cycle, for you might be 5, 7, 10 years. It's like how much really, especially like there's foundational, like a roof or HVAC unit and all, like in 10 years, like they're not going necessarily. So, obviously you have to put money aside, to your point, for the budget and that kind of thing. But to be putting, 30% aside, every single year in those early days, it's just that I always feel like there needs to be that balance. So if you're looking at it that way, where you kind of have the life cycle, almost like you said, like a depreciation kind of a schedule on where you think, how long on average you should have with this and that. I think that's very important. You must be coming up with some really great models when you when you're getting into the decision making and stuff like that. What's that look like?
Yeah, I certainly love my Excel spreadsheets. That's another thing engineering helped me with. But yeah, I've got quite a few spreadsheets and models and CapEx plans laid out, and it honestly, everybody's so different. Like I've seen a number of other investors and other GPs that have built their own models, and everybody's got just a different slant to it. It's really about what works for you, like what makes sense for you, because it's at the end of the day, you're the one making the decisions, and all the Excel spreadsheet is a tool to make a decision on
Sure.
whether that purchase price that you're putting in, that basis you're going in at, is actually the right one for you in the investment.
Yeah, that's a great way to like just simply boil down what all that means at the end of the day, right? Because that could be intimidating, I think, for a lot of investors. And to your point, it's like if you've seen one, that just means you've seen one. It doesn't mean that you right that you've seen them all. Or I've heard that joke with family offices. It's like if you've met one, it just means you've met one. They're all, a lot of them could be structured different and think differently, invest differently, all that kind of stuff. And it's the same thing with models. People have a lot of different thoughts when it comes into that. But I like that. I think that's a simple way to, is it justified in the basis? And does or are you making conservative, expectations and things like that, and projections moving forward? So what does that look like from an investor standpoint? I would think when you're so hyper focused locally that you're finding a lot of your investors in those local markets. But at the same time, I would think the Carolinas have been very popular, very hot, that you could also be dealing with a lot of outside people. So what's your the marketing and the capital raising and all that kind of stuff? What's it look like?
Yeah, I mean, both of those are true. I've got people out in California that are interested in partnering. I've got people that are like 30 minutes away that are
Mhm.
interested investing. And it's really about finding the people that match with the business plan. So not everyone wants a long-term investment. It's
Sure.
not like doing a refinance after a couple of years. That helps with a lot of people, but there are people that really just want to like get their money in, get it out quick, like 3 to 5 year hold max.
Yeah.
That's like get peak IRR, right? Like a lot of the recent investments have focused on what is the IRR, giving the highest IRR.
Sure.
That's really much more about speed of money than it is about overall return.
Yeah.
So we focus a lot more on unlevered yield on cost, which takes out it strips away leverage. So it strips away like whatever the lending's doing. I don't care what interest rate is necessarily. And it strips away that IRR basis, that speed of thing. It's really about, okay, once this gets stabilized, am I making more money than I would putting this into like a treasury or something, right?
Sure.
Like that's really what you want to know at the end of the day. And that unlevered yield on cost really helps you do that.
Yeah. So, I was going to ask you that with this long-term approach, is the goal to refi and continue to hold, or do you really want to sell the property off in 10 years or so, or what's that look like?
Ideally, it's refi and hold.
Yeah.
I mean, I'm really trying to find those locations that we believe are going to last for that long, or if not longer. So anything that's really close to, like Charlotte is a great example because like I think Charlotte's going to continue growing and growing and growing. Like I don't see any signs of it slowing down anytime soon.
Sure.
But you have to get more specific about that if you're looking in some of the tertiary markets nearby. Is like, okay, you may not have population growth there, but is the market stable? Like if you have industries coming in, and they may just be very localized, like furniture companies up in High Point, or even like nobody's going to heard of like Randolph, North Carolina, for example, right? But there's a Toyota mega battery plant going up right outside of like about an hour south of Greensboro, that they're investing over $1 billion, and they're bringing in like 13,000 jobs, and like it's a huge thing, but it's literally in the middle of nowhere in North Carolina. And so like knowing those kind of things can help you say, okay, this little tiny town that no one has ever heard of happens to be 10 minutes from this giant thing that's blowing up. And so if I can find a property there, I know I'm going to be able to have people that want to live there, and it's going to continue growing for a while. But it's just hopefully that's kind of that's a really good target for getting some off market properties that maybe haven't been the focus for a while.
Yeah, I love that. Because that was one of the questions I was going to ask you. There's been so much interest in those markets, at least the main markets over the last few years. Are there concerns for how new development's going to affect the market? Like I'm in the Mid-Atlantic, Northeast, so it's like that we have not had that kind of boom of new development that the Southeast has had and down south and things like that. So we still have a lot of supply constraints, but curious to what that looks like for you. It sounds like you were saying yes there. And then, how do you balance that? How do you factor that into your plan? And how long do you think that will continue for? And is there a lot of land for new development? Because some of these tertiary markets, it could be built out or maybe not. So I'm curious to what that all looks like.
No, it's a great question. Supply is one of the top things that we look at because it's such a huge driver of rents. So even with the older products, if there's something brand new going up next door, if that brand new product can't hit their rent numbers, they're lowering their rent so they can pull in enough occupancy, right? So that's going to impact even the older product. So in Charlotte, especially, and also Greenville in a number of ways, and Greensboro now to some extent. I mean, the whole like along I-85 corridor from Raleigh down to Greenville, South Carolina is just the whole thing I love. I think there's a lot of great markets all along there. But in terms of supply, when we get a brand, like I'll talk to Charlotte just because it's so local for me. But we've had a huge amount of new supply come in, and it has driven rents down for sure. Like we've seen that across A class, B class, and C class in the area. It hasn't, I would say C class has probably been the most resilient, mostly if you have a low enough basis, but generally it's been pretty tough on rents. And that means it's also getting tough on prices for purchasing properties. And so that's actually why I'm bullish on buying right now. Like for the next, I'd say that we're having like a supply drop off. So we've had a lot of construction starts have really, really slowed down recently. So the last deliveries are kind of happening over the next like year or so. And then the rents have been really resilient. Like they've dropped, but they haven't dropped a lot. Like you would have thought they would have dropped a lot more given the supply coming in. But we still have almost 100 people a day moving here. So it's like we're still got all this influx coming in. It's getting absorbed. And I think probably in the next 3 to 5 years, Charlotte's going to turn that corner. Rent's going to start popping up. We're going to start seeing new supply again. So we've got this little couple year trough, in my opinion. That's a great time to buy where you like, I'm very strong Charlotte in the long term, but it's going to hit prices it's on the properties a lot more because your rents are dropping. People can't quite get the occupancy they need. I really try to focus on properties that are less than 90% occupied because a lot of times there's management problems or maintenance problems. A lot of times people can't get financing to buy them. And so it kind of diminishes the buyer pool. So I can be more aggressive in purchasing that. And then if I can get those, I know how to manage it. I know how to fix it. I'm going to set it up for the long term. It's really for me about getting it at that low basis. And I think the next probably 2-3 years, we've got a really good chance to get that right now.
Yeah. Wow. That sounds great. The what drives the financing issues there? Is it just the higher vacancy? And then how do you make up for that? I'm just assuming you're just raising more capital or potentially buying cash if the numbers make sense and it's not too much of a raise, that kind of thing.
Yeah. Yeah. So that's all true. So if we can buy it cash, then we'll buy it cash. It's definitely preferred if we've got something super distressed. A lot of the distress typically happens because of lower occupancy. And a number of the properties I'm seeing right now have been on the market for 9-12 months and on and off the market, gone through a couple different brokerages, that sort of thing, but they still can't get above that 90% occupancy. So then the question you have to ask when you're looking at it is why?
Sure.
Is it fixable? Right. So in some cases it's not fixable. Like it's just in a terrible location and somebody just overbought and they didn't realize it at the time and now they're just kind of stuck. But there are properties where it's like, okay, no, it's in a walkable, bikeable location. It's generally a decent looking property. Layouts are good. So what's wrong with it? Sometimes there's no washer dryer. Like in this area, having a washer dryer in unit is worth probably a $50 to $75 rent bump over top of one that doesn't have it. So if you're looking at competitive rents, one has washer dryer, one doesn't, then you're like, okay, well, they can't get their numbers up to where they thought they could because they didn't invest in getting washer dryer hookups. Is there parking? Some of the older ones that are like more infill tiny locations don't have as much parking. You might have to add a couple spaces or try to figure out see if there's a way to fix that. Again, it comes kind of back to that investment up front. It's like, all right. And the other thing is draw in. So sometimes people, again, go back to paint. The ROI on even exterior paint to like freshen up a property, a rename, like so that people stop associating it with the previous name, the previous management. It sounds silly. And on some of these smaller properties, if you're dealing with like a 10, 20 unit, you don't actually have to put up a sign that has the new name. You just have to start calling it something different on Google Maps.
Yeah, exactly.
And on apartments.com. So you just have to call it something different. Yeah. And all of a sudden it's a new, quote unquote, new property. If you've repainted it and it kind of rebrands it without like signs can get expensive. So you like, it's one of those things you can put a mural up. Like we've done stuff where we've gotten local artists to come make our sign, a mural that is our sign on the side of a brick building. Yeah. So that really kind of draws in the local community aspect and people get excited about that. There's just all these little things you can do to really recognize that this is a service industry. Like I think people forget that sometimes, like definitely. You are serving your investors and you're serving your tenants and you have to know what they both want in order for this to be successful. So if you just go after the investors, the tenants aren't going to be happy because you're going to be cutting corners there. If you just go after the tenants, the investors won't be happy because they're not getting the returns they want. So you kind of have to balance both in order for this to be a successful business venture.
Yeah, it's one of those things that sounds like, of course, but you feel like not everybody always looks at it that way, unfortunately. But actually, it leads into my next question. We talked a lot about like kind of property management throughout the conversation, but we haven't spoken directly to it. So it sounds like you're working with third-party property management. Is that correct? And then, what's that relationship look like? What's your expectations? Let's talk about the PM side of the business.
Yeah, I work with both. So we have in-house management for about 40 of the units, and then the rest are all third party. We've gone through a couple different property managers, and I know a lot better what I want now than when I first started. So as we talked about at the beginning, I started out doing things pretty much all myself, including management. And so I didn't hire a third party property management until I got to that 6 unit that we talked about earlier. And so that was maybe 20-ish units or so.
Okay.
And so by then I knew how I would manage a property, but what I didn't know is how somebody else would manage that property.
Sure. Yeah.
And I've used I knew I could manage the 6 unit myself, but I kind of, again, the preventative looking ahead is like, I wanted to know like what I didn't know.
Yeah.
So I said, okay, I'm going to give this to a third party and see what happens. So I went through an interview process, found somebody, they did a decent job, but I didn't know things like should have access to Appfolio, right? So some of the smaller property managers, they just won't they won't give you access. And there's no real good reason why. But at the time I was so new, I didn't know that was I think I asked once and they were like, no, we don't do that. And I was like, okay, we can just kind of let it go. But now that we're managing a couple hundred units that I've got to follow up with, like being able to log into Appfolio, pull my own reports whenever I need to, send them to the bank, that helps me so much. And it cuts out the property manager so that they don't have to spend the time catering to whatever reports I need. And it makes sure that I know what's going on. So like they can't hide stuff because it's in their system. It's much harder for me to not see. Like it's on me now. It's like I can go in and actually audit them a little bit and say, okay, is what they're telling me real? And with the ones I'm working with now, it is like we haven't had any issues. But for example, we're going through a refinance, or we're starting to refinance on a property now. So if the bank needs a report or something, I can just go and pull it. I don't have to wait for the property manager to send it to me.
Yeah, that's crucial. Yeah, I mean, the timing there and just getting things done in a timely manner that's going to make that go smoothly. To be able to go in and do it yourself is crucial. What other things are you looking for from like an interview perspective, relationship? Like, what did you learn over the years that kind of those non-negotiables, anything particular that you want to see? And because I think you make a really good point, and I think people that are more on the active side, where they want to own properties themselves, manage them, that kind of thing, they think getting a property manager is passive to some degree, and it might be a little bit more than if you're getting the phone calls yourself, but you still very much need to manage the managers. And I don't think everybody always realizes that necessarily. There's a lot of work that goes into that too. And so curious to if there's any other kind of non-negotiables, things you look for.
Yeah, so I typically have if it's a property that's stabilizing, which has been most of my experience up till now, like I haven't really, I've gotten like one property actually stabilized. Everything else is still in some part of that transition. I'm typically having calls with them weekly, and that's so that we can check base. It's typically only a half an hour. They send me the reports beforehand, so I get kind of a summary of what they're thinking, and that gives me a chance to send them an email back and say, hey, this is the questions I'm going to have during the meeting. And so then we make the meeting a lot more productive.
Nice. Yeah.
One of the other things I typically look for is I interview their bookkeeper. I know that sounds kind of strange to some people, but the bookkeeping for a property management company is huge. Like that is one of their major things that they do for you, is make sure the books are clean, that they're keeping track of all the money, where it's going. And if their bookkeeping is not up to par, they're not willing to really talk to you about it, that you don't have a direct line of access to their bookkeeper or bookkeeping company if they're using a third party, like that's a red flag for you to like, you need to be sure that you're comfortable with them otherwise, because that's really one of the biggest things.
That's a really good point. Yeah.
I think the other one's always lease up. I've developed, I want a key point of contact per property. So even if you're managing a remote, even if you have a distributed team, right? So you've got multiple people that can plug in, there still needs to be one person that is responsible for a property. And that's because otherwise I get passed around, or not like stuff gets missed. Like you need one person who's responsible to know kind of what's going on everywhere. And if they don't, like, at least I know, I ask a question to that person, or a tenant asks a question to that person, they know who to go contact to figure it out. But that one key point of contact is a big one for me as well. I don't do like, they just call the office number and somebody will pick up. Like, no. I need a name. Like, has to be a specific person. And if they go on vacation, which is fine, I need who that specific backup person is. Just it's such a huge thing. It's such a person business. We're back to this being a service industry. Like, if you know the name of the person who's hey, I have a maintenance issue, and you have a relationship with them, like when you've called them before, they've been really understanding or helped you out, then the tenant's a lot more likely to be like, if the person says, actually, no, we don't really fix that, they're like, oh, okay. Whereas if they're being bounced around, they get frustrated and
Sure.
it turns into a much bigger issue than it needs to be.
Yeah, that makes a lot of sense. Well, that's all great insight there. How do you run the construction like management side of the business? So it sounds like you're doing heavy renovations. You know, we were talking about some properties where there were fire damage and some damage from a lane and some natural disasters, that kind of thing. How do you run the construction side? Do you let the property manager hire a construction manager and you manage them, or do you do that part in-house, and or do you have a general contractor on the team or something like that you work with? Like, how do you look at that part of the business?
I do that in-house. So that's part of the
Nice.
thing I love doing.
Yeah,
So
sure.
for me, it's fun to do the contracting and management.
Mhm.
So when we hire for the smaller stuff, so if it's an interior renovation on just a turn or something, the property manager's handling that
Okay.
pretty much 100%. They have guidelines around what the finishes need to be.
Okay.
We talk about what the budget needs to be, and we talk about if a vendor is busy or unable to do that, we'll talk about what other vendors might be acceptable. But
Mhm.
after that, they kind of have, this is their guidelines, and then I'm just following up with them on that weekly basis to say, hey, how's this going? Is this working? Is it not? But on the bigger projects, so for example, on the 28 unit that we're rebuilding after the flood, um, I've got a co-GC that's helping me out there. So I'm talking to him on a weekly basis. I've managed it, like he's got a MS project schedule laid out. We've got a whole contract laid out on a line by line item, almost as if you're doing a new build.
Yeah.
And that's letting me really dive into the details with him and make sure things are on pace. But I'm also going out there. So I'm very much a hands-on asset manager. So I go out to the property, I walk the units, I take pictures for the bank because we are getting draws from the bank from the insurance money,
Okay.
and just make sure, like, have conversations about, hey, this doesn't quite look right, or hey, I thought we were going to be on this property. Oh wow, I thought the windows were getting in 3 weeks ago.
Sure.
And they're like, and a lot of times it's, hey, we just move things around in the schedule. And that was one of the conversations I had with my GC recently. Is we were talking about how project management, especially people who don't do it a lot, if you get a schedule up front, they expect it to go exactly per that schedule. But really what you're doing
Yeah.
is you're trying to keep this end date, and then you move everything else around
Exactly, yeah.
between, like on an almost daily basis, hourly sometimes.
Yeah.
But the goal is to like keep rebalancing as things change so that you can keep this end date and the quality in place. And not that many people understand that. And so that's where my background comes in. And like I said, I really love doing that kind of stuff. I work really well with contractors because I understand how that works. And so I much prefer to do it myself than to outsource that to a property manager.
Yeah. I think that's definitely great insight there. It's I feel like I've heard it said before where it's like you can pretty much count on the schedule being exactly how it's not going to work out. Like you could pretty much hang your hat on it's not going to happen exactly that way. But a great point. The end date, you obviously want that to stay the same. How anything else gets done in between, that's going to be a moving target. And those things should always be like living, breathing schedules. They shouldn't be set in stone necessarily, because things are going to come up and all. So they kind of have to live and breathe with the project. But the end date is usually the most important part there too. Well, wow, this has been one of the best conversations I've had on the podcast around multifamily, the operations, the asset management, all that stuff. You're really in the thick of it. So this has been an awesome conversation with so many great nuggets. I can't wait to go back and listen, take notes and things like that, because you just drop so much wisdom throughout the podcast and the interview. So really appreciate you being here. How could investors learn more about you and what you're doing, and just get involved and get in your world there, Rachel?
Thanks, Peter. This has been a lot of fun for me too. Anybody who wants to contact me, we're at clovercapitalgroup.net. You're welcome to reach out to me by email at rachel@clovercapitalgroup.net. And yeah, I'm on X as well at CloverCap. That's a big real estate community as well. If you're not on there already, just FYI.
People keep telling me that I'm not, what I mean, but people keep telling me I got to get on there. It's crazy how many times I keep hearing that. It's a sign.
Yeah, that's how I found some financial partners on there, and I'm actually going up to New York in May for a gala that they're having just to get together for a whole bunch of people. Somebody's hosting it, just getting all the real estate people together. So it's a lot of fun on there. But yeah, those are the big things. I'm also on LinkedIn. I haven't posted on there in a while, but if you have sent me a message, I will respond.
Awesome. Well, thank you so much, Rachel. I really appreciate you being here. Great conversation. I can't thank you enough. Thank you.
Yeah, thanks, Peter. Have a good one.
You too.